Good evening, I'm John Batchelor. This is the John Batchelor Show. We're going to Asia. We're going to discuss Asia because while there's trouble in Europe, Greek drama is not concluded. It will go on for days. I don't expect anything looking like a resolution, even with a referendum on the weekend. If that happens, we can concentrate on China because this is a time that China is leading for the 21st century. This is the rising power, said to be overtaking everyone but the United States and eventually the United States. But there is trouble in China. We've talked about this for months now, maybe more than years. This trouble, though, is not something that the Chinese Communist Party can correct by fiat. It's the markets. There is capitalism in China, and there is intervention, but there's intervention in all capitalist systems. So I welcome Gordon Chang, a Forbes.com contributor who has traveled in these last hours, and it's morning time in Hong Kong. Gordon, the Shanghai Shenzhen markets have been, well, to call them volatile is to understate. That is not the whole story of the Chinese economy. You tell me that the Chinese manufacturing has been dipping these last months. They're in a recession, Gordon, right? They're in a recession that the Chinese Communist Party is not capable of announcing. Why, Gordon? Good morning to you.
Good evening, John. Yeah, I think the Chinese economy is probably close to zero growth. Now, they claimed 7.0% growth for the first quarter, but when you start looking at underlying numbers like electricity down 0.1%, trade down 6.0%, construction starts down 18.4% for the quarter, plus, after that, obviously the economy has deteriorated, and now it's having an effect on the stock market. So this is a very bad story for China, and especially with the release of the new PMI, Purchasing Managers Index, for June, confirming that the manufacturing sector is continuing to contract.
We welcome Fraser, Howie. He is reporting all the time. Red Capitalism is his book, but we're talking really about what China does to all of Asia. It has been the engine of growth these last years, and the markets in particular have been showing instability. I'll use that word very carefully. Good morning to you, Fraser. The instability at Shanghai Shenzhen, and Gordon just gave us statistics about the general economy, the overall economy. I've known for some time that the markets were detached, were disconnected from the economy. They're pretty much a casino right now. But the behavior of the markets this last week, to call it crazy is to understate. How do you read what's going on in the Chinese economy? Good morning.
Good evening to you, John, and morning to you, Gordon. Well, as I say, how you read the Chinese economy is just as Gordon explained. That the official number may say 7%, but you look around and there seems to be very little evidence that 7% translates into growing businesses. Everywhere you look, demand seems to be falling. There seems to be very few things growing, and that how you get to, you can add up a lot of negative numbers, as it were, and end up with a positive growth of 7% on an $11 trillion economy or something, just seems to make no sense, and certainly does not seem to gel with any logical analysis. If you look at the stock market, it has been very much detached, although the volatility of the past week, or the past couple of weeks, has always been expected, or certainly should have been expected for the past 6 months. The timing was uncertain, but a nasty downturn was always expected. You had a tremendous bubble created largely through leverage, largely through government support and editorial saying that the Chinese stock market is the next great thing, and a lot of support there. But when you have a market rising 3% a day for a month, as China effectively was doing for some periods, then you know that there's going to be a nasty downturn coming. Nobody necessarily knew the exact timing, but when markets start to fall, they have a life of their own, and markets fall about a third faster than they rise, and that's exactly what we've seen. It took from about mid-April to get to the highs in mid-June, and in the past 2 weeks, 3 weeks, they've returned to where they were in April. And I think it could easily fall further. There's no reason why not. The swings have been just quite incredible.
Gordon?
Fraser, the Chinese stock markets are about 25 years old now, and they have volume which exceeds New York. They're very, very large. You'd expect them to be mature. But what we have seen over the last 2.5 weeks is extreme volatility. So, for instance, the stock markets can fall maybe about 5% in 1 hour, which occurred a couple days ago. This really seems to be a very strange story because the bigger the markets you have, you would expect less volatility, wouldn't you?
Well, you certainly would. I think you make the valid point, and this is what China loves to play. This, we're an emerging economy. Just we need more time to develop or something. But you're absolutely right. China's had stock markets since actually the first shares were issued in the late 70s, and it certainly had formalized stock markets for roughly about 25 years. They are very large. They've got lots of listed companies. They've got tremendous liquidity. But fundamentally, the nature of the stock market is highly speculative. And the reason is that the government has never allowed the market to act as a market. It's always tried to control it, either through policy decisions, by controlling the companies that list, by effectively setting the rules, by being one of the largest shareholders. It has not encouraged a large institutional base of investors who are actually taking a long-term interest in Chinese corporates. Instead, every investor in China, regardless of being big or small, is speculative in nature. And you've seen that particularly in the past 6 months to a year.
Gordon, you have mentioned to me that the Chinese government or the banks that are controlled by the Chinese government are intervening in the market now. How so, Gordon?
Well, especially a couple days ago, we saw large purchases of Chinese ETFs, exchange-traded funds, and those funds were invested in essentially larger state enterprises that were partially listed. And so basically what we have is the Chinese government coming in and buying shares to affect prices. Also, they've tried to affect prices by announcing that the National Pension Fund would be putting at least up to 30% of its holdings into the stock market, and through essentially creating more liquidity by reducing interest rates, for instance, and reducing the reserve requirement ratio. So there have been a lot of ways that they've been influencing the markets. But you've got to remember that what they've been doing with these stock purchases is essentially a partial renationalization of these enterprises, and that's a very bad trend that you just can't explain.
Fraser, there are capital controls in China, strict ones, although I imagine there are ways around in the black market. That means that the money coming out of the real estate bubble of these last years has gone into the stock market. That's my supposition here. Where does it go with the stock market showing volatility? And I tell a quick anecdote. The volatility that warns of worse ahead looks like this. I remember back in March of 2000 when the NASDAQ prepared for its fall from grace. It touched 5,000. And over the next month, it was extremely volatile day to day. And it was seducing people to enter back in at a better price. But then the market just continued down into bear territory and stayed there for years. Is that what we're seeing now? Is that a good guess of what's happened? And where do they take their money if they can get it out?
Well, that's certainly what we saw before when the last bubble in China was 05 through to 07, 08, and when it collapsed there, you saw it in the doldrums for years, literally afterwards. And interestingly, even this bubble hasn't even got to the highs of that previous bubble. So just even though this has been quite incredible in terms of liquidity and turnover, $200 billion being traded a day, it may be too simplistic just to say, where does all this money go? I think, there is so much liquidity in China. You've got an M2, basically broad money supply in China, twice the size of the economy. There is tremendous liquidity there. Some of it, of course, will look to basically try and get out of the country. It will go into and come out of the country. A lot of this money has been built on credit, though, and so therefore it's debts need to be repaid. There'll be losses sitting somewhere for people who have borrowed money and have actually now to trade the stock market and lost it. So it's not clear where it goes. And again, the last thing the government should be doing is just trying to inflate another bubble. Because fundamentally, there's no good reason why you should be buying Chinese property or anything else now. The economy remains in the doldrums, and there's long-term restructuring that's needed. That's the fundamental problem. So China has a horrible position that's flooded its economy with money, and there's no real good investment out there in China at the moment. It's very nasty, and I think that the government's certainly very worried about it.
Fraser Howie is co-author of Red Capitalism, the Fragile Financial Foundation of China's Extraordinary Rise. Gordon Chang, a Forbes.com contributor. Fraser is in Asia. Gordon's in Asia. We're going to speak of Asia tonight. I'm John Batchelor.